Hello, fellow traders. 'Tis I, the Rumpled One, coming to you on Wednesday, December the 2nd. The year's 2020. Let's talk trading. Instinct versus intuition versus impulse. And just so you know, these videos are for educational purposes only, and your results may differ from mine. What am I talking about? Instinct, intuition, impulse. Well, impulse is when you do something when you really haven't thought it through. You just jumped in a trade, or as we like to say, you airballed a trade. And then when you look back, you can probably see 3, 4, or 5 reasons why you shouldn't have entered a trade. In fact, I did that this morning. The pound had tanked. It came up to the 25 psychological line, and I jumped in the trade. Well, I really should have waited because price then retreated, never gave me a chance to take profit. And I was down about 20 pips and I waited it out. Plus, I was on my phone. I was talking with Wall and I hadn't, come down to the trading room. I was doing this off my phone, which really isn't a smart thing to do. I mean, sometimes it works, but not really a smart thing. I was impulsive, you know. Now, I was kicking myself though because yesterday before I went to bed, I looked at the price and I just kept thinking, this sucker's got to drop. It's got to come down to 39. I just know it does. But then I thought, no, let me be smart. I go, well, just put on a penny a pip trade. I'm like, no, don't even do that. Well, of course, if anything, I probably should have put on a McGilla trade and I would have made bank. But I didn't do that, and that was my intuition. And it was also kind of my instinct. Sometimes something will come up. You'll have your signals and you know you should take it, or you might know you shouldn't take it. And that's your instinct. You got your signals, and it's something because you've done this so many times. You see something, but you might not be able to vocalize it. And in a way, you don't know what you're doing other than following your instinct. And your instinct tells you, do not do that, do not do that. And you don't. And then you're happy that you didn't do it because as we've said many many times, trades like buses. There'll be another one. So if you miss out on a trade, it's no big deal. The market will give you another opportunity. You just have to wait for it to come around. And there's no one opportunity that's just so great that it's, a once in a trading lifetime opportunity. Those trades happen almost every day, every week, or every month. And the thing is, once again, so long as you've got your risk management in place, you really don't have much to worry about because you've already decided you're willing to lose X amount on that trade. So whether you get it impulsively, an instinct trade, or intuition trade, or just following your trading plan, it's all the same. You get in the trade. The worst thing that should happen is that you lose the amount you're willing to lose. Now, the thing about it is, and this is key. And I watched a video yesterday, and it didn't have anything to do with trading, but it was something that was key because it was kind of talking about some brain management, and actually, it was talking about procrastination and the reason why people procrastinate. It's not because of time management, okay? That's not the reason they do it. I forget the second reason people think they do it, but the real reason they do it is because they attach a negative emotion to it. So when you're sitting there at your trading screen and you hesitate to trade, it's because you are attaching a negative emotion to what your loss means. You've already decided in advance you're willing to lose this amount per trade. So if you enter the trade and it goes against you and it hits your stop, there's no reason to attach a negative emotion to it. It's just part of trading. So why is there this negative emotion attached to that loss? It's funny because Walmart, I'm gonna out him a little bit right here. Um, he was doing a demo account today as opposed to trading real money because he's thinking about. In fact, we're both thinking about doing something, going to a different broker. So he's testing it out. And he says it's so much easier to trade when you're not trading your money or real money. And if you think about it, there's so much truth in that statement. And hopefully I can get him on tomorrow and he can elaborate from his side of the fence. But the thing is, if you lose somebody else's money, if you don't have a negative emotion attached to it, then why do you have it when it's your money? You have to kind of get down to that, because if you lose 10 pips and it's not your money, and that's how much you're willing to lose, when it is your money, you lose 10 pips, should be no negative emotion. Because if you can get rid of that, just that one thing, then chances are you'll take the signals that you're supposed to take, and you won't take the signals that you're not supposed to take, because you won't have the fear of losing out or fear of losing. You won't have the fear of missing out. You won't have any regrets. So you won't experience any pain because you won't have any negative emotion. And that's just so key. And once again, if you take the profit before the market takes it back, you won't have any of that negative emotion either. So, for example, yesterday I was in a trade, or maybe it was the day before, I was up 5 pips, moved my stop loss to break even +1, and if you know the rest of the story, it hit my stop, turned around and took off. Now, and so why do I get mad? I followed my plan. Why do I have a negative emotion? Why do I kick myself? Because you know what happens the next time. I don't take the 5. I don't move my stop loss to break even +1. It comes down and then it keeps going down. And then I experience, an even worse loss as opposed to a gain. So it's one of those things where it's all about managing your emotions more than managing the trade. If you can just be neutral or be happy no matter what happens, whether you lose, whether you win a little, take a 1, you take a 5, you take a 10, or you take more. If if you're happy, or at least not mad or upset, no matter what happens, your trading's going to improve. It really is. Trust me on that one. Of course, these videos are for educational purposes only, and your results may differ from mine. So let's go on. Now, this is that wick zone chart, and what I did was I turned off 2 of the indicators. So we'll just roll through the time frames. Let's start with the month. You see here, price broke out of the previous month's high, but then came back into that wick zone. So you could have actually been trading this line in both directions, just trading this line here. And had you traded it to the short side, you'd be up 63 pips at the moment. So that's one thing you can do here. So right now we're in that upper wick zone of the previous month. So you can look to go short at call it 20, and look to go long, say call it 97. And then of course you could trade crisscrossing if you want to do that. Just, once again, simple horizontal line trades. And the other thing to note is this is the candle top here. So basically, you're in a buy zone right here. This is the buy zone area when you're within 10 pips of this line, or 5 pips. Usually for monthly and weekly, I like to do 5 pips because it's going to explode. out of those ranges. The open plus or minus. And right here, we're right there at the weekly open, +5, now +7, now +8. See, now +10 right there as I stated it. We got within that 5, price is going to explode out of it. And I think I saw a 12 here. So there was a chance to take, 5, 6 pips. Boom, just like that as I was talking. And by the way, that pound filled the gap. Remember that big gap here? So anybody who took that trade, they were rewarded handsomely. So this is now looking at those zones here on the weekly. Except I just realized something. Why isn't this showing something? Oh, time frame monthly. Something weird just happened. Oh, I'm on a different chart. That's what happened. Never mind. Go back to the daily chart. So here, if we switch down time frame, I switched charts. We look at the weekly. You can see we're in that upper wick zone for the previous week. And you can see there wasn't much of a body. And then now if we come down to the daily, you can see we came out of that upper wick zone through the buy zone here. Actually, and this is the short zone, and came all the way down here out of this wick zone and then back up through it. So once again, trading these horizontal line, the previous day's high low, the previous day's open and close, trading across those lines, horizontal lines can be profitable. And set this back to the month. And once again, filled all the wicks here. 2 pips below the weekly open, now 3, now 4, now 5, now 6. Okay, we've got the opening range right here for the week. We've got the opening range here for the month. And you see we broke out of that range for the month here, the opening day for the month. We also broke out to the bottom side for the week, and then we came up through it. So once again, for the people who want to do those long-term, can't sit in front of the computer because I got a job, these are the types of trades you can look for. But of course, price can move against you. You could be sitting in profit. You don't take profit and turns around, hits your stop loss. So you have to consider that. For the year, 81 pips above the open. And looks like we made a yearly high yesterday at 81. No, not yesterday, earlier in the year at 81.8. That inside bar, we came into it, broke out just a couple of pips there, and then shot right back into that zone. So for those of you like trading the inside bar, there's another opportunity. And you know what? I guess I spent so much time talking about that one thing. The fastest 15 minutes of trading is up. So intuition, instinct, or impulse. Just remember, it's not what you trade, it's how you trade it. So go out there and drain the banks. And if you're new here for the first time watching the video, welcome aboard. This is TheRumpledOne, over and out.